You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. This is your host, Jennings Smith. Guys, I'm not alone today. I've got a special guest, Kris Morin of Three Peaks Capital out of Connecticut. And extremely excited to have him on the show. He's been in the deal room for a while now. He was able to close 200 units last year. He's on track to do 2,500 units by 2025. Got some stuff going on in the Midwest. And he was a teacher before this. So I wanted to have him on the show, kind of hear his story. We talked a little bit before we got recording. You know, there's some things that are going really, really well. There's some lessons learned, some mistakes made. We're going to dig into that. So Kris, welcome to the show. Appreciate you being on, man.
Yeah, man, it's a real pleasure. I'm glad to be here.
Absolutely, absolutely. So let's start a little bit at the genesis. So you said in your bio, you were a teacher, and now, you know, you're completely doing real estate full-time, plugged in. Now you're closing a portfolio, building, 200 units in a year. Pretty good little bit of growth there. So talk to me about how you got to where you are now.
Yeah, it feels like it wasn't a very linear journey, that's for sure. I think I got to this point where, I think like a lot of folks, I left college and I got a master's degree and I thought, wow, this is it. I got a graduate degree, like I'm going to make all this money. I got a job as a teacher making $36,000, and that was like a few rungs up the ladder. That wasn't even the starting. I was able to command a higher premium because of where I came from. But I remember like my idea of going out to like a nice dinner was Friendly's. Now, if you're from the Northeast, you know what that is, but it's just basically like a restaurant that serves ice cream, but you're talking like a $10 sandwich. And I knew right away, I was like, I'm meant for more than this. I have way too many skills and strengths. And I was really kind of obsessed with the idea of making money. And somehow, somewhere along the way, even in college, I started dreaming about real estate. I don't know why. I don't know how. Nobody in my family does it, but it was just something that I just knew it creates millionaires. So fast forward, I'll tell you this. I didn't stay in education for very long. I quit after my first year. I was sort of dead set on like learning all I could about business and figuring out how to eventually get into real estate. I was a really motivated guy. I have a twin brother who had a business major. So I took all his finance books and started reading them and networking. And I ended up getting a job as a business consultant for one of the larger firms in the world, who then sort of rounded out my business education. The company's called Accenture, and ended up doing really well and sort of rapidly accelerating through the ranks there, which ultimately led to some executive roles in some Fortune 150 companies. But, around the Great Recession, I was like, I don't know, I think I was 28, 29 at the time. I said, that's it. I'm doing this real estate thing. Started buying some courses, throwing everything I could on credit cards at the time. And, so I started off flipping houses. Like I think a lot of folks think that's naturally where you're going to start. I'm going to make some lump sums of money and I'm going to buy a multifamily. But I'll tell you this, I was one of the lucky ones. I think I figured it out. Some of my strengths came forward and really helped me. I was raising capital. I was flipping houses. I was traveling as a business consultant. So I said, hey, I'm in Detroit every single week for work. Why wouldn't I just build a team and start flipping houses in Detroit? And then, I'm off to Richmond, Virginia. And this story goes. And I sort of built this operation where I was doing business all over the country, but I burnt out. I mean, anybody who flips houses knows you're really just babysitting contractors. And, not every project goes according to plan. There's always scope creep and I was really burning out. So I let that business run itself out about 2015, took about almost a year off, and then started buying multifamily, and I never looked back. So really been more focused on multifamily for probably the last 7 or 8 years. Small multifamily mostly, buying up 4, 6, 10 units here and there around Connecticut where I live. And when COVID hit and, the prices shot through the roof and killed the economics on the small stuff, I thought this is the time to move upstream. And I ended up finding you, jumping into the deal room. Kind of the rest is history. So that's the long story of the journey there.
See, but I kind of like that. I like that you had a base, of flipping houses, understanding some of the headaches that come along with real estate, starting with deals that, probably weren't going to take you under if they went sideways, a 4-unit, a 6-unit. And you see everybody sees wow, he closed 200 units in a year. That's amazing. And it is amazing. However, there was a lot building up to that. And now you're in the position where you've got the skills, you got the ability, you understand the game of raising capital, but more importantly, you understand the game of underwriting, operations, buying in the right markets, making sure that you don't amass this massive portfolio and then 2, 3 years later, half of it's crashing down, which, we're seeing some of that, guys that overpaid in 21 or 22 or didn't even overpay, but they weren't prepared for the operational side of this business, which, can be a lot.
Right. Yeah, definitely can.
So let's talk about the burnout, because I know there's a lot of people listening, myself included. I was a contractor, one transaction after another, flipping houses, one transaction after another. But it's so easy to slip into something that you're comfortable with, that right? It's like, I know how to analyze these houses. I know what markets to buy in. I know how to make the profit on them. What gave you the confidence or the courage or like, I have to do this to move into a bigger asset class?
Yeah, well, I guess I had always thought, I think for most people, or at least for me, when I think of real estate, I equated it with passive income, right? But here I was very actively immersed in this business, sacrificing every ounce of myself for it, whether it was chasing down new deals and following up with cranky sellers, or trying to close the next one, and then you're circling back and trying to check up on projects that were in the works. And there's almost always something that's just going wrong somewhere, right? And you've got contractors that steal money or run off and don't show up on a project one day. I mean, we could talk all day about the number of things that you run into, but really it just came down to how active I was being and how difficult the market was becoming. After 5 years after the Great Recession, you couldn't throw a rock and hit a foreclosure anymore. There was much smaller inventory. You had all these gurus popping up online telling people, I'll teach you how to get into the business. So you saw this huge influx of, these emotional bidders driving up bidding prices on projects. And now you've got profit margins going down. Just combine all those things, right? I remember hanging up the phone. I was in a hotel room in Richmond, Virginia, checking up on a project in Connecticut. And I was like, that's it. I'm done. Like, this is not passive income. This is not why I signed up for real estate. And I let the last couple of projects just run themselves out. I had a contractor that was screwing me, and it felt like it was happening just like project after project. With flipping houses, I think anybody who says they've never lost money, they're either lying or just haven't been in it long enough. But, you make money, lose money. And sometimes you can lose really big. And it's like anything that's active. The second you stop, the income stops too, right? So there were a lot of reasons, but the light bulb finally went off and I said, I've got to do something different if I want to get where I'm going. This definitely isn't it.
I'm reading a book called The Dondo Investor, and it's basically, it talks about the Patels. And if you've been in real estate long enough, especially motels, hotels, and apartments, you probably heard the name Patel. They originated from a small subset of India, and you think, oh, Patel must be like the last name Smith over in India, but it's really not. But what happened was in the 70s, they got forced to immigrate to America, a lot of these groups, and within 50 years, they own half of the motels in the United States, which is incredible in 50 years. This small subset, but their kind of mantra is Dondo investing, which is extreme value investing, where their risk is very low, but their upside potential is really, really high. And when I think about, the concept of flipping a house or even development, which I'm really not a big development guy, it's like you have to buy something, you've got construction risk, you've got timeline risk, you've got market risk, right? What if the market pulls back? What if it's not worth what I think it's going to be worth in 6 months or whatever? Or in development deals, you're talking multiple year timelines, and also with no income. There's no cash flow along the way because it's not a rental. It's just a retail fix and flip. Whereas with apartments, I mean, absolutely. I've had some deals that have gone better than others. I've had some deals that have gone not so great, but I've got that income coming in. I'm still paying down debt. I have time to work my plan. I have time to wait it out and let market conditions improve or let my NOI build up, and I can make a mediocre deal into a winner because there's income coming in and it's really, really mitigating my risk versus I'm outlaying all this cash and then, you lose. I mean, number one rule of investing, according to Warren Buffett, is, don't lose money. And so if you can consistently break even, make money, and then hit those, double, triples, home runs, while having a very disproportionate risk level. I mean, that's what I really like about rental real estate, where you have income coming in to kind of learn and adapt. Whereas if you make mistakes on fix and flips or development deals, I mean, like, it could crush you.
That's right. Yeah, it's great points. And I always tell people, especially new people, they're like, well, I'm going to start with flips because it's lower risk than multifamily, right? I'm like, just think about that for a second. Everything about a flip is just based on a projection, I guess, right? And there's so much that can change that's outside of your control. And you make a mistake in this business and they end in multiple zeros, right? You're not selling used iPhones on Amazon here. And so that could bury you. But, if you've got 3, 4, 5 rents coming in month after month, if you lose one or two, like, you're still in the green. But you're right. I love multifamily, even on the small stuff. When I got started, and maybe this is more relevant for newer listeners, I started buying 4-family houses. And I started by raising money and people in the community around me, friends and family, wherever I could. And, they would say to me, what happens if the economy turns, if we have another great recession? I say, great, I don't care, right? Because it doesn't mean the rents go away unless you have a total loss of income, right? But if it's really, truly that bad, then there's worse things going on in the world than losing a little bit of money. But the reality is rents never decline. Growth might fall flat, but the rents are what they are. And you've always got your tenants paying. And so, to your point, I just ride it out until the situation's better. If I'm in a situation where I want to sell, I'll wait till conditions are optimal. But at the end of the day, I know I'm in it for 10, 20 years for some of the small stuff that I intend to hold long term. I don't care if the economy drops out from underneath me and I lose technically $200,000 in equity, because I'll regain it and then some. And then in the meantime, I'm making $100,000, $200,000, $300,000 a year from the income that I'm generating from those rents.
I had a front row seat to that, exactly what you're talking about. In the late 90s, early 2000s, my dad, he finally got into rental homes. He bought his first rental home when he was, I think, 47 and maybe 50. And now he's got 15 houses paid off. His house is paid off. He's retired. He has a very, very good life. I wouldn't say he blew it up, $100 million, but he's got a great life. He built what he wanted to build. But in the recession, he told me, Jennings, my net worth on paper was cut in half, and I didn't care, right? Because I was on long-term mortgages. My rents stayed the same. I didn't raise rents on people for 3 or 4 years, but they stayed the same. I continued to cash flow. I continued to pay my debt down. And then, in 2012, 13, 14, like, I was back to where I had been pre-recession. Now, obviously, prices have doubled and tripled, at least in our market, from where they were in 2008. And so, that ability to not necessarily have to look at the balance sheet and say, oh my gosh, I've lost all this money. You have staying power, because real estate, extremely forgiving given a long enough time horizon. Even if you buy bad, if you can cash flow and you can hang on, odds are you're going to be all right.
Exactly. That's exactly it. Yep.
But speaking of cash flow, I want to talk about that, because I feel like a lot of people, myself included, I got into multifamily for the cash flow. I was like, oh my gosh, I'm looking at these guys who are marketing saying they have 500 units, 1,000 units, 2,000 units. I'm like, they must be making $1 million a month in cash flow, right? And now I'm on the other side of that. Obviously, we both have a portfolio, and we see, right? We see, okay, we pay the expenses. Wow, expenses might be higher than we thought. We pay the debt. We pay our investors, right? If we didn't do this on our own, we've got to give our investors a return. And at the end of the day, I have found that cash flow is not nearly as significant as I thought it would. Have you seen that?
No, I think that's exactly right. Especially, given where we've been over the past even decade with such a strong market, you're paying a premium for these properties. So, if you're underwriting it right and your expenses really aren't coming in too much higher than you thought, you might only be hitting a 6 to an 8% cash on cash. And that's what it takes to get your investors into the deal in the first place. So to your point, like, all the cash, the net free cash flow that is, left over for distribution, like, that's not going to you, that's going to your investors. And so there might be, if you've got a 3 to 5 year hold period, you might only be collecting the asset management fee if you have one. And sometimes that amounts to just a few $1,000s a year. And I always tell people that who are newer to this business, like, they'll be like, well, do I make any money along the way? And I said, yeah, but the best way to think about it is as if you're making nothing, because it's so little. It's not like you're going to live off it, right? So you get your acquisition fee up front. and you work your butt off for 3 years and you sell. And if everything goes to plan, that's when you get paid again. And so to your point, the cash flow, it's even when it's good enough for your investors. It's not something that's going to feed you along the way, unless if you're doing a traditional, again, 70-30 split and you're paying a premium for your properties. I'm sure some folks are getting a slightly better deal than that, but that's been our experience to date.
Well, and I mean, case study, we just sold a 63 unit that we bought 3 years ago, and I don't even know if I got an acquisition fee, but we got a little bit of money at closing. We paid a 10% preferred return, and the equity split was, I think, 30% to the investor, 70% to the GP, because our preferred return was so high. But we paid that pref current, every month. And so that definitely wiped out all cash flow. We refinanced it. Now we're taking on more debt to get the investors out. And so now our mortgage payment jumps up, which took away most of the cash flow. However, so for 3 years, I really made no money on that deal. But at sale, we were all in for 5, including the investors' cash. And, we ended up selling for 6.9. And so we made a whack of money right then, but it was 3 years in the making, right? And now I'm able to take that piece of money and actually turn it into passive cash flow, and that's where I think without cash, your own cash, it is difficult to generate significant cash flow. You can, but I think the name of the game really is using other people's money to safely control assets so that you can get that windfall at or sale. Or if we had held the property for another, 5 to 10 years, I think it would have cash flowed. But at the same time, if we held it for another 5 to 10 years, like there's more renovations, there's more parking lots, there's more air conditioners, there's more roofs. Those buildings never stop eating money. So I just want to clarify that for the listeners out there, that the biggest piece of the pie is appreciation. And so if you can get that thing to cash flow, pay your pref, you're going to do well, but you're going to do well later. You got to be patient. It's a patient game. But as that compounds and exponentially grows, it can turn into something pretty awesome. But I want to tell people the truth,
Right. And I know you want to talk about this, so I won't jump too far ahead. But all of that depends on flawless execution, your property management team doing what you've originally contracted them to do, right? And so you could, at the end of the day, wind up in a situation where you don't get paid and you're like, oh my God, I worked my butt off for 3 years and I made almost nothing. And so, but I think the point that I want to make for anybody who's new, if I see this, people get this wrong, I think a lot. They think of, well, if I'm going to get into syndication, it's passive income for me. That's just totally the opposite, right? It's passive income for the LPs. It's very active for you. And again, I think your payment depends entirely not only on your performance, but this other team, this property management team that you've contracted to do a lot of the work for you. And so, it's not a stressless situation at all. There's a lot of work to be done and there's a lot of sleepless nights. And so if cash flow is really the goal, then I think other folks have to do a good job of figuring out like how they're going to supplement that along the way. But just wanted to make sure I threw that in there.
Yeah, absolutely. I think of your property manager, if you think of an apartment as a business, which is, that's all it is. It's just you're buying a landscaping company, you're buying an HVAC company, you're buying a manufacturer, whatever. You're basically buying a business. However, most of the value is tied into the physical asset, which is why they're so attractive to people. And that's why they're fairly easy to sell versus another mom and pop business. But when you're doing that, you're hiring, your CEO is the property manager. So you don't have to be the CEO. You don't have to run all the operations and the employees and et cetera. But if you got the wrong CEO, that CEO is going to take that business down in a hurry. So let's talk about that. I think this was this the 56 unit or the 58 unit?
56, yeah.
Okay, so 56 unit in Evansville, Indiana. Talk to me about purchase price. What was the plan? What was the exit? And then let's get into the property manager.
Yeah, so we've been looking at so many deals since we acquired it roughly a year ago that I can't remember all the specifics off the top of my head in terms of original projections, but purchase price was roughly, our original purchase price was roughly $3 million. We were only planning to renovate about half of this stock. We wanted to leave some meat on the bone for the next group of investors. Fort Wayne is a growing market, and it's also really starting to accelerate in terms of investor attention. So we knew that there would be plenty of buyers on the back end. So that was kind of the plan, short-term hold. The good news is we got seller financing on this one. We did a 3-year note. I think we have fixed interest on that at 5%. I always try to imagine all the different worst case scenarios that can play out. And so to further de-risk the deal, I negotiated an option to extend that contract for an additional 2 years if we needed to. No extra penalties or fees, and he bought it. I don't know why he bought it, but we can just basically say, hey man, we want to extend 2 years. It's interest only for the first 3. It cash flow is really good. So even if we start paying principal you start at year 4, we're going to be in really good shape. So the economics on this deal are favorable. We're returning original projections. I think we did like a 6 pref, and we're targeting 16 to 18 average annual return. And right now we're ahead of pro forma. Our NOI is ahead of target, both in quantity and schedule, if that makes sense, by 17%. And so we're looking really good from a valuation perspective.
Well, let me interject there, because I would say if you're not ahead on your NOI right now, you're behind, because cap rates have been expanding. That thing is probably not worth what you underwrote it at, 2 years ago on the exit, right? So I've seen that where we've done everything right as far as increasing rents and NOIs, and because the cap rates have expanded, that valuation is just not as high as we had originally thought, because the Fed raised rates, 500 basis points in 2 years.
Yep. That's exactly right. And one of the things we did, and a lot of folks don't necessarily have appetite for this, but one of the things that we did that was a smart move was start to accept. This is actually a portfolio deal. So there's 22 units on one side of the city, 36 on the other. On the 22 unit, it's more of a C-class area. Let's put it that way. It's not rough by any means, but it's C-class. So we decided to form a partnership with the local housing authorities, and we're getting $300 a month higher than our pro forma targets. And our pro forma targets we were getting a lift on like $100 a unit. Now overall we're getting about $400 more per unit because we're taking Section 8 in those units. They're happy to fill them up. We're doing little to no capex on these units. I mean, we're spending no money. We're blowing the income out of the water. So that's been a really good move for us. And I think more and more cities have such a strong need for landlords who are open to that. They now give double security deposits, at least in this particular part of Indiana. They basically, I wouldn't call it insurance, but they basically guarantee, hey, if this tenant does any damage up to like $8,000, like we'll cover it, we'll pay it, because we don't want you to go away. So even at turn, like if there's anything that needs to be fixed, it's not even coming out of our budget. So it's just a sweet situation for us. Our investors love it because obviously all of that extra cash flow is going back into their pocket. But there's a downside to the story, right? Like we're painting this picture, like, wow, this deal is great. There's got to be a turn somewhere, right? And you and I were talking about this. So we hired this property manager. We went out on a limb a little bit with her. So it's basically, think of it as like a startup. There's a local commercial broker who said, hey, we can be better service to our buyers if we also had a commercial property management arm. So they wanted to build that in-house and then be a one-stop shop. And we decided, hey, let's contract with them for this service, because this woman, we'll call her Jane Doe for just to protect her identity, but she's great, very experienced. She was kind of an institutional level quality person. She came from large property management companies. She had all the experience and the knowledge, and we thought, we're going to be the first customer. We're going to get all the attention. Well, that's also half the problem, right? Because as she was expanding her portfolio quickly with no real staff around her, we started to feel that burden. But what we realized later on was in the finer details of our property management contract, we were basically stuck using their preferred contract team, and they had some special arrangement with them where they would get them so many hours of work at such and such fees, and they also layered on a small margin for themselves on top. And so, when we were anticipating, unit turns to be anywhere from 10 to 12,000, they start showing up at 15,000, even 20,000 in some cases. You can understand that we got concerned really fast. I mean, so we were paying attention to the numbers. We saw that in the first 2 months, but when we started to fight them on it, they basically held the contract to our face and be like, you guys signed on the dotted line. So we knew right away we screwed up. So we had to find ways to control that cost wherever we could and be a little bit more thoughtful about how and where we were turning units. But we were burning through our CapEx budget in year one like it didn't even exist. And so that was the real risk for us, because we have so much runway left on the deal. And so that's where the pain and the problems really started to emerge for us.
Okay, so that is an awesome point. And I ran into pretty much the exact same problem. With my PM, construction company, or whatever you want to call it, preferred vendor, was also associated with the PM. And yeah, I mean, CapEx budgets were being blown. I mean,
Yeah. Yeah.
for comparison, we were getting charged, 12 to 15,000 a turn on one of our properties. And when we switched, we were able to do the turns for $4,500 a turn, you know? And so, it's a big lesson learned, but you almost want your PM to be in an antagonistic relationship with that contractor. You want them fighting for every dollar for you. And when it's hey, you scratch my back, I scratch yours, like we're kind of all milking the ownership group and the property for as much as we can get. Doesn't matter if that fee is cheap, if the maintenance costs are through the roof, right? And so, to anybody listening, having the construction company very, very close to the PM, it's really not going to serve you in your best interest. So watch out for that as you're hiring a PM. Were there any other red flags that you missed in hiring that company?
That we missed? No, because I think I would say we were good about acknowledging the situation that we were walking into. Maybe she was a good salesman, but we felt really good about her. But that was really the big mistake. And I think really the biggest mistake was missing the details on the contract. And we combed through that thing multiple times. My partner is even an attorney, which that probably makes us look bad, right? But that's what he does for a living. Somehow we missed it. But that's maybe the lesson here is to really, don't just sign documents. Make sure you really comb through them with your team. Make sure you really understand, have the right protective clauses in there where, say, okay, we're going to agree to this. But if at any point you deviate, from the business plan, then we want some language in here that we can kill it at any time, those kinds of things. So that was really the miss there.
Okay, so you got rid of her and got someone else. How painful was that? What did that transition look like?
You know what? So that transition has been really smooth. The only real hiccup that you feel as an operator is during that first month of transition, tenants are confused about where to send their money, and you've got to chase them down and get them set up on new payment portals. And some of these people might be older and not real tech savvy. And you basically, what it translates into is you have a month to a month and a half to 2 months where like it looks like you got all this bad debt, you're not collecting income, and so it sort of upsets the P&L. But you just have to know that you have the right team and the right process, that all kind of self-corrects over time, and it did. I'll tell you this though, we were closing earlier, sort of halfway through this year, on our 58 unit in Evansville, Indiana. So complete opposite end of the state. And we had been working with this larger regional property management company. I'm going to tie this all together. They've got a footprint of about 5,000 units. We've been really impressed with them. We've flown and walked properties with them, underwrote deals with them. We knew they weren't telling us what we wanted to hear to land the contract. We had checked references. We did all the things that you'd want to do to make sure you're jumping in bed with the right partner. And when we closed on Evansville, we'd already started talking about letting them take over Fort Wayne. But one of the things that we did after learning from some of the mistakes, I basically, I'll keep a long story short. We can go into it if you want to. With interest rate was obviously a lot higher in the Evansville deal. It's a recourse loan. We had to hit our numbers because I didn't want some small bank president to freak out if we start falling off the business plan and screw us big time, right? And so I wanted our interests to be aligned. I wanted the property management company to be a good CEO, to your point, and make sure they're hitting the numbers. So I went back to them and I said, hey, can we wipe out your fees to 0% in year one? So our cash flow is great. Our DSCR looks great to the bank because they're going to audit it, because they're going to freak out. And we basically did a step up where it went 0%, 1%, and then it jumped to their full fee of 5% in year three. And I said, all of that deferred income that you're waiting on, we will pay you on the back end. We're going to give you equity in the deal. So if the deal hits the numbers, you earn that money and then some. And we gave them enough equity where they would double that. So just to give you a perspective, this is a smaller deal. So they were only waiving like $35K in fees that they would have collected over a 3-year period. And on the back end, if we hit all our numbers and then some, they're going to get at least $70,000. So they agreed to that. Now they have real skin in the game. They have to perform if they want to get paid. And they asked us, they said, well, if we don't hit the mark, can we still at least get the 35 you owe us? And I said, no, this is performance based. Welcome to our world. Like you're not going to make anything at all. So, and that's been great because they pay more attention to the details now than I do. They're all over it. And so we've also given them over management rights over the new property up in Fort Wayne. We didn't give them equity in that deal, but that behavior, that mindset has really carried over. And so far, we're only 2 months into that, but it's working out tremendously well, and we're sleeping easy at night. We feel really good about it. And to your point, unit turns are going from $20,000 to 4,500. It's a remarkable shift.
Okay, so what if you had done this deal and they had agreed to it, and then a year into it, you realize they're no better? They're not doing it. Would you have had the ability to fire them? Like, what would that have looked like?
Yeah, so we do have some specific language that our two legal teams worked on, but I basically had a long chat with them. I said, everything in this business is performance based. I basically got them to agree to that and buy into it. And so there's language that says we can fire you at any point in time, but there is, I don't want to attempt to explain it here. I could share it with you offline because I'll butcher it. My partner really led that conversation, but there is sort of it's kind of the equivalent of like doing an appraisal. If you're buying out a partner at any given time, you want to know what the property is really worth. So there is a process where we will do an assessment, and we'll be able to grade their performance to that date and give them some chunk of money if it's owed to them. But if it's not owed to them, they're basically out. They get nothing. But we do have some language in there to protect everybody, including them.
Okay, yeah, because I know stories of people doing the same thing where, hey, let's make the property manager an equity partner. They're going to have buy-in, et cetera, et cetera. It seems great on paper. However, then when they're not performing, they may not have the ability to get rid of them because they're an equity partner. It's a lot easier to fire a subcontractor than it is to get rid of a partner. So I'm glad that you thought that through. Okay, so how did you find these two deals? They seem like they're going pretty well. I mean, $3 million for 56 units. Looks like you're paying about $52,000 a unit. How did that come about? Was that a broker relationship? Where did you find that deal?
You're gonna love this answer. Deal room. No,
okay. I didn't know that.
But like, it goes back to the importance of putting yourself in the room, right? But not being, not just sitting there behind a curtain, being visible and vocal, contributing, building a network, actively sitting on phone calls with people, adding value where you can. Long story short, I spent a couple of months in the deal room, and I apparently left an impression on a few folks. So one of them, who was one of the more established operators in the group, called me up and said, "Hey man, we're closing like 3 other deals right now. I know you're like in the Indiana market, right? Do you want this?" He just passed off the warm lead to us, and we ended up taking it all the way to close. So it was really just the networking that I had done that ended up, leading us down that path and getting that deal. So that was pretty awesome. The second deal in Evansville that we did in Indiana, that was just consistent, deliberate, disciplined broker networking. And, originally when we set off to do commercial, so when I decided I'm going to move upstream from the small multifamily into commercial, and I formed this new team, and I said, we can cast the wide net. We can just try to get deals anywhere and everywhere. And if treat it as a volume game, underwrite as much as possible, maybe we'll get a deal. Or we could pick a market. We can call every broker in that market, underwrite every deal that we off of LoopNet, like all the crap deals. And I said, it'll be an investment in our time. It's kind of a waste of time, but it's really an investment in time. And it worked like a charm, because what happened was brokers were in their face. They kept seeing us, hearing us, but experiencing like the consistent, transparent communication. They saw, hey, these guys actually really know what they're doing. They're really serious about buying here. And that pretty quickly opened another door for us to start getting better off-market deal flow. And so I think being really focused on a market, getting to know it, and really pounding the phones with those brokers, even getting in front of them if you can. And that's just, it's just no real secret behind it. I mean, that was really the path forward for us. So we built relationships with some of the better regional brokers in the area. And now they give us a pretty strong and steady, pipeline of deal flow. And so that's really where we got that from.
So now why Indiana? Why the Midwest? Because it's like, I know Evansville, Indiana, Fort Wayne, Indiana, Cincinnati, Ohio. Those are your 3 larger properties. What attracted you to the Midwest there?
Yeah, well, Indiana, Cincinnati was really, it's funny because we wouldn't target that on our own, but there was somebody that I know who called me up and said, "Hey, can you help us close this?" So that was more of a capital raising co-GP scenario. But for us, Indiana was a very deliberate move. And I guess I could talk all day about it. But if you think about if you were to trace back migratory patterns of people, like movement patterns over time, it follows this trend of affordability, right? People tend to go where it's cheapest to live. Taxes are the lowest. You can start a business, right? It's more favorable to business owners and landlords, et cetera. And, I always say a lot of people go and retire to Florida, not just because of the sunshine and palm trees, because of the favorable tax environment for them, and the cost of living is much lower. And you'll see that there's a lot of truth to kind of what I'm saying, because even during COVID, when you've got a lot of, some of the nation's financial elite from Miami, New York, California, et cetera, all started flooding the various markets in Florida. Now you see the boomers who are on a budget are actually being pushed upward into Alabama and Georgia, seeking more affordable places to live. And Indiana right now, you can look across the board, and Fort Wayne in particular has been cited as not only one of the top real estate markets in the country because, the average cost of home, but the cost of living, the affordability across the board for everything from healthcare to groceries, you name it, is pretty much the cheapest in the country. And Indiana, again, as a whole, is really cited as one of the more affordable places to live. Then when you look at job growth and wage growth, that's on par with the rest of the nation. So in other words, you can go there and make as much money as you can elsewhere, but it's going to cost you half to live there, right? So naturally, you're already seeing a large influx of people into the various Indiana markets, and I think that's going to continue. Moody's Analytics, Wall Street Journal, a lot of really reputable sources have already said, hey, Indiana and Indianapolis in particular are seeing some of the strongest rent growth in the United States over the last year. And oh, by the way, it's projected to continue over the next 3 to 5 years for a lot of these factors. And then some. And the other part of the equation is the supply dynamic, right? We're not being flooded with a whole bunch of new supply like Texas, driving down rent premiums, and you have to hand out concessions because you're fighting for the tenants. And even when you look at new construction and permits being pulled, there's virtually none. So that imbalance that's in favor of us as operators is going to continue over the next 3 to 5 years. So, growth is going to be strong. There's not going to be new supply to disrupt that. So again, I could go on, but for me, Indiana makes a lot of sense economically.
Well, yeah, man, I have personal experience. Did a deal, 42 unit in Logansport, Indiana, which is a pretty small town. And the rent roll was around 18 to 20, and within 3 years we increased it by over 50% to 32,000. Sold it for $900K profit, and it was a phenomenal deal. Basically bought it for 2, sold it for 3, and so it was a great deal for us. And there was definitely a limit to what we could do with the rents, but on our initial underwriting, these rents were at $450. Like, hey, we can get $750, we can get $800 here, and we could, and we did. And so I like Indiana. Easy to deal with, taxes were low, insurance was reasonable. It's definitely a friendly for business state, more so than California, Illinois, the Northeast, etc. So I love it. I lived in Indianapolis from when I was 2 to 6 years old. So, yeah, my parents moved back home. But, all right, man. Well, hey, Kris, we're running short on time, but I appreciate you joining us. Now, Three Peaks Capital, this is are you working on anything currently? And who are you looking for to help you, drive this forward and to drive their goals forward?
Yeah, so that's a great question. So we have a very full pipeline right now. We've really decided to dial it in on Indianapolis in particular. So we're still focused on Indiana. We've kind of cut back on underwriting in other markets. But I guess if somebody has a lead on a deal in Indiana and they're looking for a team that could bring it to the finish line, like, we're willing to do that and pull you in as a partner. We've had other people bring us the deal, and we just take charge and sponsor it. So there's an opportunity to learn with us and grow with us there. If you're an LP and you're looking for a team that, makes data-driven decisions, and they think about, the economics of the deal thoroughly and comprehensively, I think we're among the best in that regard. I think, you'd rest easy investing with us. I'd love to have a conversation with you. We don't have anything under contract right now, but again, there's a lot in the works. So, I'm hopeful that we'll see something hit here early in the new year. And I think, they could reach out to me. I'm really the business development and investor relations guy, so I'd be the one that they would want to talk to. Our website is offline right now, threepeakscap.com. We're actually having a complete rebuild done at this very moment. So depending on when you're listening to this, it may not be there, but we're relaunching. But find me on LinkedIn and Facebook. I'm super responsive, and we'll get the conversation started.
And guys, if you're listening, Kris, his name is spelled Kris Morin, Morin, Kris Morin. So look him up on Facebook, LinkedIn. Three Peaks Capital is his company. Buying in Indiana. If you like that value investing for cash flow, buying stuff at a pretty good price per pound, low price per unit, where there's upside on the rents, this is what Kris does. And if you're listening and you have a deal in Indiana, well, hit him up. Maybe you can get into a multifamily deal with Kris. So Kris, thanks, man. I appreciate you spending some time with us this morning. And guys, make sure you spend some time to unlock your life. Alrighty, peace.
This is thepodcastfactory.com.